We're talking
Yeah.
about interest rates. They have been falling. We've seen 2 consecutive rate decreases by the BOJ and more anticipated as we head into 2025. Do you need to change your investing approach now? What do we do now?
Yes. So as it is, of course, as we know, the local stock market on a whole, if you look on the indices, so of course, like the main market, combined market, they haven't been doing so well for the last few years. Part of that, of course, has to do with the higher interest rate environment. There's other things. I mean, some of the fundamentals of some of the companies, again, as a consequence of the higher interest rate environment, hasn't been the best. So that has put a damper on things in the market. Now, of course, if you go back a bit, you'll see where before all of this, you go back a little bit before COVID time, you would have seen where the market, so about March, I think the market peaked around August 2019, right? You would have seen about 5 years of very strong performance in the market. Now, part of the underlying driver of that, of course, was a low interest rate environment that propelled things forward in terms of companies' earnings and all of that. Now, again, the reverse is playing out, meaning when you got the rates going up, COVID created a shock to the market, rates going up, higher inflation levels kind of triggered that also. We saw that put a significant damper on the market. Of course, you have valuations and earnings for these companies and multiples in the markets high coming out up to about August 2019. And then, of course, when you had this COVID shock slowdown in the market overall, then you see that pullback there. Now, we've been in the doldrums for a while in the market. Now, we're getting the interest rates cuts. Now, of course, we're in the early innings of it. About 50 basis points coming out of the BOJ locally. So you have 50 basis points from the Fed in the US. But the trick is, as we know, when it comes to investing, you're not really you're looking at where things are now, yes, but also the more important thing is where things are going to head, right? So you want to be ahead of the curve. So as it is, in general, when these rates come down, that is when you want to reposition yourself now into, of course, you can, there's other asset classes, in terms of how you position yourself in fixed income, but specifically, today we're talking about like the equities. You want to position yourself in equities broadly. Now, of course, there's specific names that could outperform, which would, of course, try and gravitate towards, but in general, that's what you want to do. So one of the ways that you can do that, of course, is that you can, for example, take advantage and buy into like unit trust type products. So particularly those that could be like equity linked, right? So the underlying assets of that is, for example, equities. That way, especially if you're a small investor, you're building up, so you don't necessarily have that capital to diversify. Probably a young investor in the market, that's a better avenue. So you can get that diversification, you can get that exposure, and then of course when the market picks up now, then you benefit from that. Now, again, I'm not saying that the market is going to pick up tomorrow or next week, but the idea is, of course, with equities, you're really investing with a longer term horizon, and you want to just diversify and you want to position yourself ahead of the curve. Because if you've looked historically at when the market moves higher, it does so very quickly when it moves higher. So the thing is, especially, if you're a larger investor, definitely you want to start early. But even as a smaller investor, you really want to start building that position at these levels to take advantage of when rates are anticipated to continue to go lower. So
When you say the market tends to flip or change or improve very quickly, like how quickly is very quickly?
I mean, all right. So if you look on some of the historical performance that we got in the market, so for example, if you look going back in 2015, for argument's sake, the market in that year was up. The combined market was up about 102%. In 1 month in particular, in October 2015, the market was up like 36%, right? In just that 1 month, right? So the idea, and that's the market, remember, when you see the market moving like this, that means there's some key underlying names that are moving probably multiples of this in terms of like 50% plus. So the idea is when those kind of rapid movements occur, your ability to deploy, especially if you're a large, I mean, if you're a smaller investor, I mean, technically, but then you get into a chasing game, which you probably want to avoid. But those kind of movements, when they occur, you don't really want to be missing them, because what happens in general when you're investing in the market, and this is the reason why you have persons like a Warren Buffett and those more old school investors that have a longer investment horizon. In general, how the market operates, majority of their gains don't occur in a small span of time. So what happens is that basically, if you're not invested in certain key windows, the market will look like a very unattractive investment for you. So in general, what happens is that you just want to be long-term invested in terms of just over time. That's a general principle. However, right now, what we're looking at now is a key thing where we're seeing falling rates, which kind of increase the urgency of that investment decision. So before you be like, all right, I'm investing, but no, that the rates are coming down, the urgency is kind of building. Because when rates were higher in the market, I mean, it's still a relatively high, but it's coming down, right? Your ability to pick up decent interest rates on fixed income papers or short-term instruments was there. But even if you're looking at like BOJ CD rates, that's significantly coming down. And then you're having more cash in the market. So basically, the conditions are setting up to provide a good environment for equities. Additionally, with equities, what happens? The dividend yields, for example, you're buying a stock now, dividend yield might be 5. Maybe you find some at 6%. I mean, some like careers would be upwards of that, right? You would look on that yield and you say, all right, 7% or 6%, you can pick up a short-term instrument some time ago that could yield a higher. However, as interest rates go down, those rates start to look really good. Now, remember, when the rates coming down, the environment in general would bode well for these companies, meaning, you look at your NCBs or whatever, their ability to pay dividends or increase rate actually gets better as interest rates go down because the company performs better. That being said, now that yield that they used to have, that yield goes up. The price that you have it at, of course, you bought it in the past, so the price is the price. Then your yield that you're getting on your base price that you bought, that goes up. So what would happen, for example, you buy the stock now, for argument's sake, or a few weeks ago, you buy the stock and the yield on it might be 3-4%. Not necessarily that great, but as the dividend yield grows, and of course you stay invested, what happens is that dividend yield based on your base cost can skyrocket now 6-7%, 8%, and then that even gets more attractive when you compare it to the other investment that exists in a falling rate environment. So basically in a high interest rate environment, there's so many levels that pull equities higher. So whether it be higher valuations, whether it be the fact that equities become the better game in town because fixed income not yielding that much, so not that attractive, or whether it be that the company can refinance its debt at a lower rate so that all else being equal, there's just more profitability. So in general, there's a lot of companies that benefit from this, and that is why you want to start taking and repositioning. So again, you can reposition with unit trust, you can reposition with direct investments. Again, talk to your wealth advisor so you can pick what option is best suited towards you as the investor.
It's a couple comments reacting to what you've been saying. Leo Phil says, couldn't agree with you more. Get in now or you'll have to get in higher. Hey,
Yeah.
how that go? And then Shells says that statement is the opposite of what everyone else, local and globally, is saying. They say it's a slow rise.
Yeah, so that's the thing. So if you look at what's happening now, yes. So as it is right now in the market, it's actually lower. As in a year to date, combined market is lower. But what I'm saying, I'm not saying that. Well, I mean, in essence, we're kind of agreeing depending on what time frame the viewer is speaking about. Because if we're talking about next week, if you're talking about next month, yes, it's gonna be relatively slow if that's the time frame you're talking. But if you're looking out a year, 2 years, what's gonna happen is that as these rates come down, then it becomes more attractive. But what I'm saying, how the market tends to operate a lot of time. And you can look on the index movements in the past, it tends to consolidate for a while. And that consolidate, I mean, it might decline a little bit, go up a little bit, probably in the band of like 5-6% for a while. But then when it moves higher very aggressively. So what happens is that it's almost like almost like a pressure pot, and it builds and then it moves higher. That's what I'm talking about. So the idea is that in a way, yes, there's a slow rise, a slow build, meaning as rates come down, because remember, the rate's not coming down aggressively, it's coming down slow. So it's not like every tick that the rates go down, the market's gonna move higher that tick. So it's kind of like a pressure pot of building, as in that the rates coming down, you're not really seeing that movement, but it's building. The interest is building, the liquidity in the market is building, and then there's like a rush. So the idea is that, don't get me wrong, as I say, it's not like this is happening next week. I don't think it's gonna happen next month either. But the idea is you want to position yourself well ahead of the curve. So again, you have that capital there to invest. You probably have it on some short-term securities. You can definitely see what's happening with the rates there, and you're just repositioning yourself for the future. Again, looking out a bit, so probably like a year or so.
So Tariq says, so basically lower interest rates lead to persons looking for alternatives to invest and get higher rates of return. The greater demand will drive up stock prices, so invest now.
Yes.
Exactly,
Yeah.
Tariq.
Okay. Yeah.
Exactly.